Hello and welcome everyone to this installment of CHS Around the Table Live. As a reminder, during the course of our conversation, we may be making forward-looking statements. These statements should not be construed as a guarantee of future events and should not be relied upon as such.
So my name is Nelson Neal, and I lead CHS Global Research, a team at CHS dedicated towards understanding commodity market trends and providing thought leadership in the agriculture and energy space. We've got a great topic and a great lineup of panelists with us today. And the topic we're going to be discussing is one of volatility in the agriculture markets. And in particular, we want to talk about what happens in our market when commodity market forces and outside market forces, what we typically call macroeconomic drivers, collide. And what happens to agriculture and what happens to the U.S. farmer in his endeavors in this type of situation. So what's happening in the agricultural market today, I think, is a common question that we all ask. And in normal times, what would we be talking about here sitting in the end of July and the 1st of August? We'd be talking about the weather and its impact on production and yield. So is it too hot, too cold, too wet, or too dry? Well, this year, we're talking about the weather, and I would say a whole lot more than that. Think about some of the other drivers happening in the broader market today. We've got supply chain disruptions, check. Labor force disruptions, check. We've got a higher interest rate environment we're trying to deal with, check. We've got geopolitical concerns that could upset global trade flows, check. We've got a hawkish Federal Reserve looking to put pressure on markets, check. We've got the potential for a recession looming somewhere out into the future. So what do all of these drivers, when you put them all together, what happens to the agriculture market and what happens to farming when all of these forces collide? So with that, let me go ahead and introduce the panelists for today's conversation. We've got a great group of them, I must say. To my right is Joe Lardy. Joe is an analyst with CHS Global Research, and his main area of focus is really on looking at commodity market fundamentals. What's happening with supply, demand, and price associated with those key commodities that we focus on here at CHS, namely corn, soybeans, and wheat. To Joe's right is Paul Hughes. Paul Hughes is the chief agriculture economist with S&P Global Insights, where he leads that team on a day-to-day basis. Paul also has an extensive background as a consultant, and I think spent, Paul, 20 to 25 years as the chief of commodity research for a multinational food company. So welcome, Paul, as our guest today. Finally, to Paul's right is Jason DeVinny. Jason is also an analyst with CHS Global Research, and his focus is on one of the key topics that we're going to touch on today. That is the macroeconomy. What types of drivers are we seeing in the broader market that influence what is happening in agriculture? Jason is also key to some of the thought leadership pieces and research that we put out within Global Research. So Joe, Paul, Jason, delighted to have you here today and are excited to learn more about what you have to say on some of these key topics. We'll run this program as a moderated question and answer session, but keep in mind when we complete the session, you're all welcome to submit questions for the panel. In order to submit questions, I think there's an icon on the presentation page that you can use. So let's go ahead and get started. Joe, you're the lucky winner.
I'm up first.
Straight out of the gate. Let's talk about a lot of the volatility that we're seeing in the agriculture markets and commodities, and certainly we've seen a lot of upward pressure on commodity prices. What are your thoughts there?
Well, there's really two big influences that we're seeing right now. And that's historically high prices and historically high volatility. And when we look back at the commodity markets, we've seen record high or near record high prices. The only time we've ever seen prices this high was back in the awful, dreadful drought year of 2012. And what goes along with those high prices is high volatility. And we're seeing volatility levels that we normally don't experience. The normal pattern for volatility is to see a spike in the June and July months which should happen, right? Because that's when we're growing the crop. That's when there's the most uncertainty. So that's when we expect to see the most volatility. Well, we introduced a conflict in Europe, and that shot volatility through the roof. And then we also came into the June and July period, and we experienced the typical summer volatility that we always see. And normally that goes up as a pretty high spike and comes back down. But what we're experiencing today are volatility levels that really haven't backed off very far. We're still at a very high historic volatility level. So what does that mean? Well, that means we're going to see prices move around a lot more than we normally would.
For example, yesterday's soybean market had a 50-cent trading range. We've already got a 50-cent trading range today in the soybean market, and the day is not even over.
So I think we're going to continue to see these high volatilities. We've got war, inflation, recession concerns, political concerns. So I think we're going to continue to see these high volatilities into the future.
You know, Joe, that's a great recap of what we're seeing in the grains markets. But gosh, if you just watch the news, it seems like volatility is everywhere. What are some of those other key markets that our audience would be interested in, where volatility is also high outside of those grain markets?
Yeah, first and foremost, Nelson, it's got to be the energy markets. We've seen crude oil spike over $100, and the impact that crude oil has on pretty much everything is pretty impactful. As crude oil prices go through the roof, it pulls along gasoline prices with it. And that becomes front and center, top of the headline news. You know, the national average for gasoline averaged over $5 not too long ago. And some regional areas saw gasoline prices of $6, $7 a gallon. That has an impact on everything from the consumer to the farmer to the global economy. And so when we see these really high prices, there is a dramatic impact. And the other area of energy that we need to touch on is also natural gas. With Russia being both a major player in the crude oil space and the natural gas space, it's disrupted those markets. And so we've seen huge volatility there. We've seen huge fluctuations in prices. And we can't forget that natural gas is the key ingredient in nitrogen-based fertilizers. And so what that's done is it's really led to high input prices on the farm. So going into this growing season, we had crazy fertilizer prices. So therefore, the farmer had to deal with kind of unheard of fertilizer prices that they just haven't had to deal with in a long time. So here we are with high input prices. We've seen high output prices or high cash prices in the commodity markets, but we still have a crop to grow. And that story just hasn't been told yet.
Thanks, Joe. So we're dealing with a situation in which prices have been elevated for quite some time now. Mm-hmm. Can you help steer us towards what some of the key or most important drivers, what are those that have kept this price so high for so long?
Well, you mentioned in the intro that normally this time of the year, we're talking about weather markets. And along with the weather markets, we're looking at the balance sheet. We're breaking down, the demand side of the equation, the supply side of the equation, and just trying to come up with what should be the appropriate price. We're still doing that. However, how do you price a war? This is an unheard of situation that we just have never had to deal with in the grain markets. How do you price a war? And given the importance of both Russia and Ukraine on the global ag sector, it's really been a challenge for us to understand those variables. Is there enough fuel? Is there actually the equipment to plant the crop? Is there enough labor to actually drive those machines and to do the work and then to grow the crop? And is the fighting going to take place in those major growing areas? And then we get to the harvest, right? Is there going to be the equipment, the fuel, and the labor in order to harvest that crop? Once the crop is harvested, are the storage facilities still going to be functionable and viable? And then if it does make it to storage, how about the transportation? Ukraine is a major exporter. Are they going to be able to get those crops out? And the market hangs on every change, every different dynamic that happens all along that cycle. The market is really key and very sensitive to that. Just this week, the first boat left Ukrainian waters to export some goods. That was a huge moment for the grain market, and that's just an example of how reactionary this market is to any changes that are happening there. And we can't forget that, you know, not only is Ukraine a major player in the wheat and the corn market, but they're also the largest sunflower producer. And I think that will potentially open up some opportunities for the U.S. We just saw this week that there was an announcement of soybean meal to Poland. That's not normally a destination that we have, but taking a major player like Ukraine potentially out of the market is opening up some opportunities for the U.S. And one more key driver is COVID. So COVID is no longer the top of the headlines here in the U.S., but in the rest of the world, it still is. It's still a big, big factor. And let's take a look at China. So China is the most populous country in the world. And they have lockdowns where entire cities are completely shut down. And in the month of July, it's been estimated that 20% of the entire population of China was locked down at one time. That has a significant impact on Chinese demand for goods, and therefore how much the US could potentially export to China. So COVID might not be the big topic here in the US, but it's something that we have to continue to watch going forward.
Great. Incredible insights there, Joe. Paul, let me turn it over to you for perhaps a slightly different slant on some of the drivers that are influencing commodity prices and the timeline. Paul?
Yeah, the combination of things driving the commodity prices, I'd say that it's a combination of macroeconomic and microeconomics. And I'm going to start with the macroeconomic first. I'm going to start where Joe left off as the COVID situation. So to kind of tell the story of how we got to where we're at, I'm going to start back with early 2020 when the world started to go into COVID lockdowns. This presented a challenge and almost a near certain recession that policymakers had never seen before. This was not going to be your garden variety recession. And so the US and other policymakers, one of the things that they did is just throw a lot of money into the economy between stimulus checks, enhanced unemployment benefits. The US government put so much money out into the world, into the US economy, into US households, that household incomes, for the first time ever in a recession, household incomes didn't go down. Arguably, they actually went up slightly with the last round of stimulus checks. So just think about that, so that household incomes are flat to maybe even higher at a time where you can't spend money on services. You can't go out to eat. It's unsafe to travel. You know, travel, leisure, hospitality, all of that you can't spend money on. So households have a decision to make. What do you do with that money? Well, you either save it or you spend more on goods. And quite honestly, they did both. Savings rates went really, really high. We're kind of seeing that manifest itself in home buying now and house prices. But at the same time, they bought a lot of goods. So the demand for goods expands out at a time where we were in COVID lockdown situations here in the US and rolling lockdowns around the world. Now, the supply chain for all things is far more global now than what it was 20 years ago. It's certainly the case for food. It is the same for most other products as well. So demand for goods shifts out, including for food and discretionary good items, and the supply chain and the supply is shifted back because of COVID lockdown situations and the supply chain disruptions globally. That's a recipe for inflation. So that's the macroeconomic things that have gotten us here. The microeconomic things also, if I go back to early 2020, one of the things is a surge in Chinese demand. China had just gotten their hog herd, which is enormous, represents 50% of world production of pork. Their hog herd had just recovered from African swine fever, which had claimed about a third of their hog herd at the time. They were building that back. That meant that there's an enormous surge in demand for feedstuffs. Think of it in terms of soybeans, of corn, other feed grains. At the same time, China signed the U.S.-China trade deal, which gave them, lifted some tariffs that were placed on U.S. commodities. So we also had a demand surge from that. And then lastly, China over multiple years had really drawn down their feedstocks of corn, of sorghum, of wheat, and that caused a surge in demand for those things to be imported, including imported from the U.S. And then the final thing, and certainly not the last thing, is this demand for agricultural commodities to go into biofuels to help decarbonize the motor fuels around the world. You're seeing that in really big ways in the U.S. as more and more vegetable oils are being turned into renewable diesel, going into California, Washington, and parts of Canada. But that's taking place here in North America, but it's also taking place in Western Europe and is likely to spread around the world. And that's been enormously disruptive for the vegetable oil markets and supporting prices on vegetable oils and oilseeds.
Paul, I think you touched on a topic that I think is a popular one, and that's this concept of renewable diesel and the LCFS standards, or low carbon fuel standards. So you're anticipating this to be a global phenomenon and a lasting one that will help to provide a key pillar for commodity prices?
Yeah, absolutely. This effort to reduce greenhouse gases, for all these countries to abide by the Paris Climate Accord, that's going to be a disruptive factor in our markets for quite some time. And it's important to keep in mind that the consumption of motor fuels absolutely dwarfs the vegetable oil markets globally. So what may seem like a small change for the energy markets is enormous in our agricultural commodities.
So that's a key pillar that helps to support prices and creates a background to this phenomenon of commodity price inflation. What are those factors that you see that may be more short-lived?
The supply chain disruptions from COVID, I think we're starting to see fewer shortages, supply chain and lead times getting shorter on those. That is kind of fading into the background. Obviously, there is still lockdowns going on in China, but for the most part, we're on the better side of that globally. And I think in time, that will continue to fade in the background.
Great, thanks, Paul. So we've talked about volatility in agriculture markets. Let's change gears a little bit. Paul mentioned it in terms of some macro forces at play. But Jason, let me turn the floor over to you. And let's talk particularly about outside markets and their influence on agriculture and on farming and ranching. Your general thoughts on what's happening there and perhaps the role of the Fed.
Yeah, thank you for the question, Nelson. And let's start big picture for a moment. There's not a country on the planet that hasn't undergone an inflation spike recently. If you look at prices today and compare them to the prices right before the pandemic, so in the spring of 2020, on a global scale, those average prices are up north of 12%. That's significant and really just underscores how significant of a situation this inflation story is. Bring it back to the US now for a minute. In November, we hit record high headline inflation. And then we did this thing where we thought, let's keep getting more records in consecutive months. And so in December, January, February, March, April, not May, but June, we set new 40-year records on headline inflation. And as it stands today, we're at about 9.1%. So that really just shows the scale of how things have shifted quite quickly over the last 12 months here in this country. So when you think about inflation, it's hitting us as consumers, it's hitting business owners and the things that you buy and the things that you sell, and you really can't run from it. If you look at the World Bank, from an ag commodities and inputs perspective, they track index prices of a variety of different commodity buckets. Ag commodities are broadly up 18% year on year. Energies are up 82% year on year, and fertilizers are up 85% year on year. And I know that's changing, almost daily, but that sets the direction of just what we're up against. So you really can't run from it. And I think it begs the question, what can central banks do about this? Well, they can't print more wheat. You can't print semiconductors. Maybe someday we can get to that point. But for now, the central banks have a set of tools that they can explore to either expand money supply, contract money supply, make the economy more hospitable, or make it a little bit more restrictive. And so if we think about just what the Federal Reserve's goals are, one of their main goals are to just create this sense of price stability for the economy. And when they talk about price stability, they mean long-run average inflation of around 2, maybe 2.5% on an annual basis. Because when that happens, it allows people like you and I and your neighbors to plan your lives, right? If you want to upgrade the family vehicle, you feel comfortable doing that. If you're a business owner, maybe you want to hire some more people or jump into a new product line. If you're a farmer or rancher, you might want to consider expanding your operation. So that's really the environment that the Federal Reserve is trying to foster. And Nelson, as you know, we're a little bit a ways from that target inflation rate.
Yeah, so talk to us about what the Fed has done so far, and any thoughts on where they will go.
Yeah, that's the right place to go next. The Fed, if they get any criticism lately, it's were you a little late to the party, and now are you getting a little too aggressive? So the steepness at which they've raised rates over the last couple of months since March is pretty steep. Historically speaking, in recent history, we haven't increased rates at that pitch. And so in March, we raised rates 25 basis points. In June, another 75 basis points. And then just last week in July, another 75 basis points. So all eyes now are on the September meeting. That's the next opportunity for a potential interest rate movement from the Federal Reserve Committee. And I think the Fed is going to wait and see, have the activities that they've put out thus far had a marked impact on bringing down core inflation to any degree. And I think that will influence their actions. Now, when you think about, the tools that the Fed has, some call it a scalpel, some call it a butcher's knife. I think either way, there's going to be a bit of an incision, and what that means is there's going to be a need for some degree of rebound in the economy, and the degree of which we don't know yet. We got to watch out how all these macro forces sort of come together. But if you're asking me big picture how this continues, I think we've got a number of rate increases yet ahead through the balance of the year, and perhaps even into next year before we get back down to those target inflation rates.
Thanks, Jason. We've talked about broadly the impacts of inflation on commodity prices and touched a little bit on input prices. The one area where I don't think we've talked much about is what it means for crop inputs and operating loans at the farm level. With the actions taken by the Fed, what does that mean for farmers and ranchers who have loans?
Yeah, let's bring it to the farm, Nelson. Interest rates have crept up over the last couple of quarters. That's being reflected in the ag loan space. So operating loans and real estate loans are increasing. Interestingly, at the same time, we're starting to see demand for new loans begin to increase as well. Not just new loans, but the size of the loans, the maturity dates of those loans are getting kicked out further. So that's an interesting backdrop of what's happening in the ag space. And I think there's a lot driving that from an operating standpoint. I think farmers are beginning to think, there's this threat of high prices for diesel and seed and fertilizer, and I want to kind of slow the cash burn a little bit and dip back into the loan pool. But from a real estate perspective, what's also happening, farmland values historically are very positively correlated to inflation. And if you look back at the 5 years leading up to 2020, farmland values nationally for non-irrigated cropland didn't really move a whole lot. It stayed relatively range bound. And then in 21, we kind of busted through the ceiling a little bit, right, through that recovery. And what's happened that's even more interesting is this first quarter, for a particular grouping of states, farmland values have really shot through the roof. Now, for states in Minnesota, the Dakotas, a little bit of Montana, and a little bit of Wisconsin, broadly as a group, farmland values are up 23%. That's a big move for this quarter when you compare it to last year's first quarter. And of course, cash rents are following suit. Those are up 17% approximately for that group. So you got a couple things going on there. If you're a farmer that rents land, your expense for renting that land is suddenly, eating into your profitability. And if you're a landowner and you've taken out an additional real estate loan, with those interest rates creeping up, you're also going to have a little bit larger line item on the income statement. So interesting times to pay attention to for the foreseeable future.
Jason, that's great insights in terms of those outside forces impacting what's happening on the farm and in agriculture. Paul, your firm has done a lot of research on food inflation in particular, where we've been, where we've headed. I know when I go to the grocery store, what used to cost $100 a couple of months ago now costs $200 or even more. Could you provide some commentary on your thoughts on food inflation, where we've been, where we are now, and where we may be going?
Yeah, it is pretty extraordinary. So if we look at, as mentioned, headline inflation in the U.S. is about 9.1%. Food inflation until about 6 months ago was kind of lagging the headline inflation here in the U.S., but it really is now leading. It's 10.4%. These are the highest inflation rates, as was mentioned, in about 40 years. It's nothing that's unique to the U.S. The Eurozone is seeing similar rates of inflation, not quite as high as the U.S., but similar rates of inflation. And again, there's a concern that once that inflation starts to, and that expectation starts to be built in, it becomes very difficult to stop. Obviously, the Federal Reserve is doing all that they can to tamp down that inflation. Some progress has been made on the commodity space. So you think of corn's come down from above $7 to about $6 a bushel. Soybeans have come down from above 17 to about $14 a bushel. Wheat prices are now at the same rate or same level about when Russia invaded Ukraine at the beginning of or end of February, beginning of March. So there are some prices have come down in the commodity space. But before that gets passed, before that gets passed on to the consumer, I would suspect it'll be some months before the headline food inflation starts to really seize an impact on that.
Great, thanks, Paul. So obviously we've got a lot of topics to digest, and a lot of points are being made here. Let's try to distill it down into what it might mean for the farmer over the next 12 to 18 months, what I like to call the good, the bad, and the potentially ugly. So Jason, let me start with you. Given what we've heard and what we know with some of these drivers, what constitutes a good outcome for the farmer?
Yeah, Nelson, lucky that I get the good side of the equation here. I think it's certainly plausible that there's scenarios where farmers can expect to continue to see their farm incomes push higher. Now, a lot of things need to align in that space for that to happen. As we talked about, there's a lot of drivers here. Provided that the Federal Reserve can continue to work hard to bring down some of this core inflation and really have an impact on prices without rocking the economic boat too much, I think that would be a very, very positive outcome, and certainly is plausible. But we need some other things to happen. We need a great August, right? Moisture where we need it, no moisture where we don't need it. And we need strong demand from countries like China. So those zero COVID policies that were talked about a little while ago, provided China balances economic growth with enacting those types of policies, that would be a good thing from a supply and demand perspective. And then, of course, we want to see some tempering of the conflict in Ukraine. There's significant market impacts, but first and foremost, the humanitarian impact of that. So we'd like to see that come down for a number of reasons. If those things can kind of fall into place and we toe the line on some pretty major geopolitical drivers that we don't have a lot of control of. I think there's a scenario that even if prices, like for soybeans and corn and wheat, continue to normalize, but still be at a bit of a premium, yet prices for inputs like diesel and nitrogen come down significantly, that would create a winning scenario for farmers.
Great. Thanks for that framing of what it might look like for a good scenario for a U.S. farmer and rancher. Joe, I turn to you. Given Jason's good outcome, what might a bad outcome look like, and what are those drivers that would define that type of scenario?
Well, for a bad outcome, we already know that the farmers already had some high input costs, right? We've talked about the high price of fertilizer. We've talked about the high price of fuels. And as Jason mentioned, potentially the high cost of land rent. We know there's some higher costs on the input side. And as Paul mentioned, we have seen commodity prices come down a little bit. What if those commodity prices continue to stay soft a little bit? It wouldn't mean that the farmer's going to go out of business, but it's certainly not a scenario that anybody is looking forward to. And we got to remember, in these high volatility environments, prices can go higher, prices can go lower. And with some of the things that we've been talking about here on the global scale as well, if we kind of see the global markets kind of move from that inflationary mode, which is usually very beneficial for commodities, into a recessionary mode, which is generally kind of a bearish or a negative impact for commodities, things could soften up a little bit in the future.
Great. Thanks for that viewpoint, Joe. And now let's talk about the ugly scenario. I did notice that Paul wore a black suit today. This was uncoordinated, I must say. But Paul, you did draw the short straw amongst the three here on the panel. What does an ugly scenario or outcome look like for the U.S. farmer and rancher, given some of the drivers that we've talked about?
Yeah, I'm fortunate enough to answer this one. I hope the ugly scenario doesn't have anything to do with reflection on my appearance. But let me start with the ugly scenario. So it's kind of some of what we've already heard, but an exaggeration maybe of it. So let me start with the commodity side of thing and the revenue side for the farmer. So one of the things that could easily happen is the Fed overshoots. They raise interest rates beyond what they really need to. So not only do they tame inflation, which if by taming food inflation, you're probably going to have to reduce commodity prices. It's hard to imagine that food inflation comes lower and the raw materials that produce the food doesn't come lower. So, maybe the Federal Reserve goes beyond what they should, creates a recession in the U.S. If you've got a recession in the U.S., probably you got a recession globally, as much of the world economy as the U.S. represents. So that would be one of the risks that I would see could bring commodity prices lower. Another one that probably didn't really show up on my radar screen until the last couple of weeks is escalating tensions between U.S. and China. Could also be detrimental to demand for U.S. agricultural commodity side commodities as well. Any of those things could start to really bring commodity prices lower. I don't think we're looking at back to long-term prices, but possibly $5 corn, $12 soybeans, $7 wheat, maybe something along those lines. But then on the cost and the input side of things, we've had extraordinarily high fertilizer and input costs. They've come down a little bit, but they're still historically very, very high. If those remain high, that would, with a much lower commodity environment, that would be problematic. And then the third thing, almost all farmers are almost certainly going to have higher costs to service their debt, whether it be operating loans or other debt, because of the higher interest rates. Servicing that debt is unquestionably going to be higher in the next 12 months than it was in the past 12 months. So that kind of brings up, gets me to that ugly scenario.
Great, thank you, Paul. So there you have it: the good, the bad, and the ugly in terms of the overall outcome based on a lot of the drivers, both fundamental drivers in the market and some of these outside forces at work. So this concludes our moderated question and answer session with the panel. As I said at the outset of the conversation here, we'd like to open it up to questions and answers from the audience, not the answers part, but certainly the questions part. There is a Q&A box on your screen if you would like to submit a question for our panelists. We do have a couple that have come in, so maybe I'll go ahead and start. Joe, I think this one is probably most apt and applicable for your area of research, and that is, how much of a correction on acres should we anticipate in association with the August 12th WASDE report? And what impact might this have on the long and short term, or the short and long term trend for commodity prices?
Well, normally the August report, we wouldn't be looking for a huge change, but the USDA told us they're going to be resurveying some states that got off to a little bit more of a challenging start. And so we have a new factor in play. Although they are resurveying those states, I don't think we're going to see this massive change. I think there's some people out there that are thinking, we could see these million acre changes. I just don't see that in the cards. I think the variables are pretty well constrained on that. And I think where we're going to be headed, both long-term and short-term, I guess this question to me feels more like a short-term answer. I don't think we're going to see a huge fluctuation on the August report. I think they're going to be a lot more focused on the yield changes than they are going to be on the acre changes.
Great, thank you for that, Joe. We've got a few more questions. And again, if you do have a question for our panelists, you've got a Q&A button there on your screen. But an additional question that came in, Paul, maybe this is most appropriate for you. We've talked a lot about grains, and we haven't talked a lot about livestock producers, cattle, hogs, and the like. So how are those types of producers coping with this high-priced environment?
Yeah, well, let me start with cattle. The cattle and beef producer, I mean, they're really up against it. Not only are they have the high-priced grain environment, pasture conditions because of the drought in the southwest have really made it a challenging environment for them. So those people in the cow-calf business, that's been a real challenge for them. Some of the other categories, live hogs prices have held up reasonably well, offsetting some of the high prices in grains. I think those looking forward, the farrowing and what hogs that are being born now, I think those they may have some challenges going forward, but nothing like the cattle industry. The poultry industry, those prices have held up pretty well. So they've been, and I think the same could be said about dairy. They've held up reasonably well, offsetting them, but no question about it. The high feed costs, the high grain costs are a pinch across the board. But I would say, the biggest amount of that brunt is in the cattle industry.
Great, thank you, Paul. We've got another question that came in, and Jason, this is probably a bit more outside market related, but I'm just going to put you on the spot here. What's more likely, continued inflation or a recession here in the U.S.?
Well, I hope you don't take this as a non-answer, but I think it's both. Technically, we're in a recession at the moment, given the last advanced look at how the quarter closed for the second quarter. It indicated that we've had 2 quarters of negative GDP growth. And so that is a widely accepted definition of a recession. Don't know the degree or depth in which we are going to be in that type of environment. But we definitely are there. And then inflation, I think we've got some room to really get that inflationary environment back down to levels that I think are going to certainly impact consumers. So I certainly expect to reside in both of these environments for a little while.
Great. Thank you for that perspective, Jason. We've got the questions flowing in now. Paul, this might be more in your wheelhouse, but it's a supply chain question. Are there any indicators of improving railroad performance moving forward? I know as we were walking through the building, you saw some of our video boards, and we keep a pretty close watch on railroad performance, but overall comments on what you might be seeing.
You know, the railroads, I mean, they have been, I'm not sure how to say it other than underperformers for the last many months. They've had a difficult time getting people to come back to work, and you know, and that has been their big challenge. And for those of you guys that are in, you know, moving the physical commodities, I think everybody's seen it, whether it is you know, raw corn, soybeans, or whether it's trying to move ethanol or soybean meal or soy products around the country. The railroads have had a difficult time moving them in the fashion that you would expect. I think they also now have the question, is a concern about a possible, you know, looming recession that's going to be around for a while. And the last thing you want to do is hire people to come back to work and then have a recession that would make you have to then go and lay them off as well. So I think maybe they've been a bit reluctant on in adding people for that reason. I have not really seen any significant changes that I can point to, or significant and lasting changes that I can point to. And I know those clients that we speak with, there's concerns about what this fall is going to be. You know, with the harvest of a big corn crop and a big soybean crop in the environment and the railroads that we're in right now.
So I hate to put you on the spot, but you know, the question angle is coming from this upcoming harvest season, and what are those optics? So would you say improving optics, more of the same in terms of performance issues? Do you have a feel for that?
You know, I would say more of the same, and I would say potentially a risk of maybe backsliding a little bit, just in sheer volume of demand.
Great. Thanks, Paul. Joe, maybe another question for you. You talked a lot about volatility in the marketplace with agricultural commodities and record high prices in a lot of cases. In your mind, what do you think needs to happen to bring those prices down?
Well, in order to change volatility, you have to go from the unknown to the known. And I think the amount of unknown variables, you know, in a normal year, you can count those on one hand. But in a year like right now, I'd have to take off my shoes to start using my toes to count all the variables that we have going on. And first and foremost is the situation in Ukraine. That continues to be a complete wild card that's going to keep volatilities elevated. And then you have COVID, and then you have that unknown, the question posed to Jason, are we going to be in an inflation or a recession? We don't know definitively that answer. And until we definitively know, are grains going to move out of the Ukraine? Is COVID going to, you know, be tamed down a little bit? Are we going to see inflation calm down a little bit? Could we go into a recession? Until we know more of those answers, I don't think we're going to see volatilities back off and come way down. And as long as volatilities remain elevated a little bit, I do think that supports more of a higher priced environment, maybe not record high prices, but certainly not dropping back down to low and kind of the bad or ugly scenario levels that we were talking about earlier.
Great. Thanks, Joe. An interesting question here, and maybe I'll do a combination here, perhaps with Joe and Paul. Are nitrogen prices high enough to bring on new production or spur new, I'm assuming, fertilizer production, given some of the price levels that we're seeing? Paul, you want to take a crack at that one?
Yeah, I'll be first to say I'm not positive. This is my area of expertise, but I'm not. The appropriate question is not necessarily whether nitrogen prices are high enough, but those margins are. Part of what's driven nitrogen prices so high is the cost of natural gas, the cost of energy. So they're up against it on input costs as well. Bottom line is I can't answer that. It really would get into whether the margin for producing the nitrogen compared to the input cost, particularly natural gas, et cetera, would expand production.
Great. Thank you, Paul. A couple more questions continue to come in. Jason, let me pitch this one over to you. It's my understanding, the question is, it's my understanding that the growth outlook for the U.S. is beginning to weaken. Right now, the Federal Reserve is saying they're concerned about inflation. Do you see the Federal Reserve making a pivot and focusing more on growth here in the very near term, basically slowing the rate hike path? And if they move to a more dovish stance, Joe, perhaps for you, how and what would that look like for commodities? So, Jason, let's talk with you. The first part of the question about this potential pivot from a hawkish view, and Joe, what does a more dovish view mean for commodities?
Yeah, and that's a really good question. And if I had a very clear answer, that'd mean I could see into the future and read the Federal Reserve's mind. My point behind that is there's never been a time that I can remember where markets and people are listening to every single word the Federal Reserve mutters for clues on what they're going to do next. And so I think we're in this situation where they've made some pretty significant moves here early on in this calendar year. And they're going to really just have to weigh all of the economic variables to see, has that done anything to slow prices? If we've gotten to a point where we get an inflation reading next month that is quite a bit higher, I think the betting money on federal funds rate futures is going to go pretty high. In that regard, we're going to get a little bit more hawkish. But if we are having an impact, the activities of the Fed are beginning to have a marked impact on bringing some prices down, I think we could get into a scenario where we begin to see a more dovish Federal Reserve.
And for commodity prices?
Well, I want to dovetail on Jason's thing. One of the best things that you can look at is the Fed's dot plot. And it's produced when the Fed has their quarterly meetings and they look out several quarters ahead and they survey just the Fed governors. So you get the dots on where the Fed governors think interest rates should be, 3 months from now, 6 months from now, 9 months from now. It's a great visual representation of what the Fed is thinking. So I think that's something interesting to look at. If you're wondering, God, what is the Fed thinking? Look at the dot plot. It'll kind of chart the course for where things could be. And in terms of what commodity prices could be, if we get into a dovish stance, I think it's going to be that walking a fine line between, are we trying to just get to that target inflation level? Or are we going to walk that slippery slope and maybe hit some recessionary concerns? So if we just walk it back and use a dovish stance and just tame inflation, I think that's still a supportive input for commodities. It's that fine line. Once we cross that line into a recessionary environment, then things start to look a little bit negative on the commodities.
Great. Thank you, Joe and Jason, for those responses. Next question, Paul, let you tee this one up. I think we've seen in the news, like the volatility index for equities is perhaps leveling off. And the question from one of our viewers is volatility in the ag space going to be more of a factor long term? So I pitch that over to you, given that we talked a little bit about some lasting drivers and maybe some fleeting drivers to this inflationary environment.
Sure. Yeah, volatility in the ag space. I honestly, I don't see it getting significantly weaker, or at least weaker in terms of historical type levels. What we may have seen from, say, 2014 to 2020. And there are a number of reasons for that. As I mentioned, the global supply chains of food and agricultural commodities, they're far more global than where they were before. You go back 15 years ago, U.S. amounted to 60% of world trade on corn, more than 50% on soybeans. about 25% on wheat. That's gone to other areas. So we now represent U.S. represents about 35% on corn, about 40-ish% on soybeans, and about 10% on wheat. Those have shifted to other areas, and areas that are, quite honestly, represent risk and volatility. You can see that in the Russia invasion of Ukraine. Those two countries 15 years ago were not a significant exporter of corn at all. And now Ukraine represents about 14-15% of exports of world corn, in normal times. And these are anything but normal times. Between Russia and Ukraine on wheat, they represent about 30% of world trade on wheat. That was maybe 9 or 10% 15 years ago. So there's geopolitical reasons, there's economic reasons that I think all points to higher volatility than is historically normal in agricultural commodity markets.
Great. So, Paul, you're essentially saying and calling for a structural shift in commodity volatility in the ag space, given some of these changes.
Yeah, I believe so. Yeah.
Perfect. Another question from the audience, and Jim, maybe I'll let you start on this particular question, and Paul, maybe you can follow up. Can you see the renewable diesel in the future can or will stand on its own without government subsidies? If so, won't it be much higher price per gallon than we are currently seeing in diesel prices? A really good question. So one of diesel price level and of government subsidies and support. So Joe, you want to start on that one?
It's always interesting when you bring a government subsidy into the mix and whether or not the product or commodity can stand on its own. And it's long been said that in order to have, we need the government subsidy in order to have biodiesel be feasible. But at the same time, we've also got legislation, LCFS legislation, low carbon fuel standard legislation in California, Washington, Oregon, Minnesota, in many different places that are saying we have to use this. So I think we're at two competing forces. One that says we have to have the subsidy, and if it goes away, what happens? Versus, hey, we need greener, cleaner fuel, and we're going to mandate that. So it's going to be interesting to see how that plays out. But at the end of the day, I'm thinking that the biodiesel story has some solid foundation and footing, and that story will continue.
Yeah, I think I see it quite similarly. If the question is renewable diesel and taking vegetable oils, converting it into diesel fuel, ever going to be competitive without some sort of government action against taking crude oil and turning it into diesel? I don't think that's ever going to happen. Crude oil is just going to be a more economical feedstock. But now, if you're going to take government payments that are going to incent the use of vegetable oils for diesel fuel consumption because it's a more green, less polluting, emits less greenhouse gases, then that and you offset the difference between the pollution between the two of them, or the greenhouse gases between the two of them. That's, I think, what's happening right now. And so I don't think it's ever going to be economical on its own, but I think those government payments are not going away anytime soon. At the same time, again, the vegetable oil market globally, let alone in the US, is tiny compared to the diesel fuel consumption globally. It only represents maybe 10% of vegetable oil production, represents about 10% of diesel fuel consumption. So there is a big mismatch between those two markets, the potential demand versus the production right now.
So if we used every drop of vegetable oil and converted it to renewable diesel, we'd still need plenty of fossil fuels.
Yes.
Is your point.
Absolutely.
Okay, another question that came in, and maybe we'll have this question and perhaps one more. Jason, let me flip this one over to you. I think you touched on this with your formal definition remarks earlier, but are we in a recession now?
Technically, we are in a recession. 2 quarters of negative GDP growth. That is widely accepted. I accept that definition, and I think we still need to. There's other forces, right, that come into play to really dictate, just how deep are we and how deep are we going to go, and those need to continue to unfold as the world is changing every single day. So technically, yes, we are in a recession, and that's what I think we're in.
Great, and with the 2 or 3 minutes we have remaining, I'll offer up one more question from the audience, and this gets perhaps closer into the world of commodity market fundamentals. But Joe, let's touch upon that weather factor one last time before we depart. And I think the question is, look, we've seen La Nina types of factors influencing crops in 21 and now in 2022. Could we have a trifecta in 2023?
When it comes to weather, I'm never going to rule anything out, but the La Nina effect is real. And the data right now currently, so La Nina, El Nino, those are measured by sea surface temperatures. That condition still exists. And even though NOAA is predicting that we may get into a neutral phase by next year, I kind of feel it's kind of a prove it to me. Let's see it disappear before we're looking ahead and saying it's gone. It's just like saying, hey, it's going to rain next week. Well, when it comes to, in terms of crop development, I want to see the rain before I start guaranteeing that it's going to rain.
No, certainly true, Joe, and thank you for that perspective. It's an interesting question. This brings us to the end of our time together. I want to certainly thank again our 3 panelists, Joe, Paul, and Jason. Wonderful insights, wonderful contributions here this afternoon. Thank you, audience, for your participation. And I will leave you with one last message, and that is to continue to be on the lookout for the next installment of CHS Around the Table Live. Thanks, everyone.